Hi, everyone. Go ahead and get started. My name is Gigi Lakites. I'm a financial advisor with TKS Advisors. Welcome to our live town hall event where we're going to talk about market volatility, inflation, and the Ukraine-Russia crisis. Just a little bit about PKS. PKS Investment Advisors is an independent registered investment advisory firm. We manage a little over 205 million, and we've been helping people with their investments, business planning, retirement planning, and financial planning for over 23 years. We are affiliated with PKS and Company, the accounting firm, and we have 3 offices in Lewis, Delaware, West Ocean City, and Salisbury, Maryland. And again, thank you for attending our event. Now, a few housekeeping items before I introduce our speaker, Dr. Apollo Lupescu. First of all, this event will be recorded and posted to our website for future viewing and sharing. This webinar format will have everybody muted, and all attendees' videos will be turned off for privacy. We encourage questions throughout the event using the Q&A box down in the middle of your Zoom screen, not the chat box, the Q&A box, and we will be monitoring that box and pose the questions to Apollo as they come. Only panelists and hosts can see these questions for privacy, and questions that we're unable to get to due to time constraints be addressed directly by our advisory team at PKS after the event. So without further ado, let me give you a little brief introduction to Apollo. Apollo Lupescu is Vice President at Dimensional Fund Advisors, one of the premier investment managers in the world, managing over $650 billion in assets. He is a nationally and internationally recognized speaker who has delivered hundreds of lectures and seminars to financial professionals and individual investors on various investment topics. Apollo is considered the secretary of explaining stuff because he has a knack for explaining complicated issues in a clear and understandable way. So Apollo has been with Dimensional in Santa Monica for over 18 years. And prior to that, he taught at the University of California. He received his PhD in economics and finance from UC Santa Barbara, and Apollo holds a BA in economics from Michigan State University, where he competed and coached water polo. Rumor has it he's still an avid player. During the pandemic, he picked up another water-based sport, surfing, which seems appropriate, Apollo, in Santa Barbara.
Absolutely.
Thank you.
Hi, Gigi. Great to see you, and thank you so much for the invitation. Thanks to everyone for taking the time to attend this webinar. But yes, it's anything that's water-based. I know you guys are close to the water. I love the water. I was there this morning at 7, so any chance I get.
That's amazing. That's great to hear. You know, I know that must keep you refreshed every day and energetic, right? Especially in these times.
I'm telling myself I'm young, but I'm not.
Well, if you're surfing, you're doing pretty good. I have to say that.
I know.
Well, to kick off the event, let's just go ahead and get right to probably the most asked question we get currently is all about the Russia invasion of Ukraine and the strong response in the Western. Sanctions have inserted additional volatility beyond what already existing concerns. How are the markets responding to this war, and how exposed are we as investors? And should we be taking any action?
Right. Yeah, it is big news, and frankly, like, you cannot turn on the TV or read something without being confronted with this invasion of Ukraine. And frankly, Gigi, for me at least, it's getting harder and harder to watch because there's so much human suffering and you know, it's an unnecessary suffering for so many people, and it kind of breaks my heart to see all this. And I've realized that emotionally, I am getting drawn into this. And one thing that I've realized over the years is that as an investor, it's really important to acknowledge these emotions because that's what makes us human. And at the same time, make sure that as investors, we are more pragmatic in terms of the actions that we take with money, because quite often the emotions can trigger investors to make moves with their money what we found is that you're better off acknowledging these emotions. It's hard to watch. It's very emotional to see all the suffering. The question is, from a pragmatic perspective, what does it mean to our money and what should we be doing? So that's the aspect that I'll address, not the politics of it, not the emotional side, but really when you look at the money aspect of the war, what are you seeing? And the first thing is that to realize, as you said, the sanctions that the Western countries impose on Russia really impact investors in a direct way. And that impact is through exposure to those companies who have that have been under sanctions. And what's interesting is that the way that we at Dimensional, and generally speaking, investors organize the world is in three categories. The first one is the US. The US by itself is its own category. And why is that? Because if you look at the companies that are part of the US market, Apple, Google, Microsoft, Coca-Cola, McDonald's, there are about 3,500 different companies that you can buy and sell in the US. We are the largest stock market in the world. In fact, if you were to redraw a world map, and instead of plotting the landmass, you were to plot the value of companies that can be bought and sold around the world, this is what that map will look like. The US is, as I said, the largest stock market, and all these companies together amount to about 57% of the value of all companies around the world. So as we have Ford and GM in the US, there's a BMW, there's a Toyota, there's a Hyundai, there's all these companies around the world that are not part of the US. So the US is its first category. The second category are the developed countries that are not part of the US. Obviously, you got the UK, Japan, Canada, France, and so forth. And together, when you look at these companies, these countries amount to about 30% of the value of all markets in the world. And the third category, which is roughly about 10%, roughly speaking, of a typical allocation, they're called emerging markets. And those are countries like China, Korea, India. And what's interesting, and the reason I bring this up, is that Russia was part of this emerging markets category. So just so you get a sense, Russia was part of this emerging markets category. And I can't really speak for all the other managers out there, but what I can tell you is that if you look at a fund, if you look on our website and you look at a fund called the Emerging Markets Core Fund that kind of covered all these countries that are part of the emerging markets. At the end of February, when this invasion began, the allocation to all the Russian stocks altogether was about 0.3% out of all the fund assets, meaning that if you had $100 invested, 30 cents out of the $100 invested in that emerging markets fund was coming from Russian securities. And when you consider that fund to begin with tends to be about a 10%, roughly speaking, allocation in a global market, what you're seeing is that in the global perspective, all the Russian stocks amounted to roughly about 3 cents out of $100. So certainly nothing meaningful. So the impact that you're seeing it as an investor, it does not really come from the exposure to the Russian stocks, because particularly in the way that we approach it, it was quite minimal. But rather, the impact of this war is coming from two different directions to us. One is economically. When you look at the invasion, it's localized right now in Ukraine and Russia. And when you combine these two economies, the Russian and the Ukraine economy, they amount to only about 2 or 3% of the value of the global economy. So not a big part of the global economy, but they do have a relatively large percentage of the global trade in commodities like oil. You have natural resources, food, agricultural products, fertilizer. Some of these things that are familiar to you folks right there in Maryland. So certainly they are outsized participants in the global trade of commodities. So one of the things that we're seeing is that this invasion has really changed the dynamics of that trade, and prices have responded to this supply and demand change. And you're seeing price of oil going up, and we all see that at the pump, but you probably fertilizers that are harder to get and more expensive. And that is an immediate economic impact that we are seeing from the war. And some folks like you probably, because I was just talking to Gigi, and you are much more exposed by virtue of using some of those fertilizers and using some of those natural resources that come from that part of the world. You're probably seeing the brunt of it. But what's interesting is that this is an immediate economic impact on us right now. The second impact is on the stock market and investing, and that tends to be quite different. And that's I want to differentiate between the economic impact that you're feeling right now on your business or your neighbor's business, but it's different than the impact on the stock market. And the reason for that is the stock market is about ownership in companies. And when you have this ownership in companies, the value of the ownership really depends on what do you expect that company to make. What's the profit outlook for years and years to come of these companies. That's where the stock market derives its value. And in that respect, what the signal from the market has been is that as painful as it is to see all of this going on around the world, a lot of these companies might not necessarily be taking a hit as much as you think. In some ways, you have some energy companies that maybe are going up. Price of oil is going up. Energy stocks have been going through the roof. But by and large, the signal that the market's been sending is that as painful as it is, this war doesn't seem to have a great deal of impact on the corporate profits of American companies or international developed companies. And in some cases, it might actually have a positive impact in emerging markets, which, if you cannot get energy from Russia, you're going to go to Brazil or some other countries, and those stocks have been going up. So by and large, when you look at the impact on profits, on corporate profits, the war doesn't seem to be as impactful as one might believe. Even companies like McDonald's and Coca-Cola, they were only deriving about 2 or 3% of their revenues from Russia. So it wasn't a big deal it wasn't as big deal as having 20 or 30% coming from Russia. So by and large, the message of the market has been that this war is disturbing at an emotion level, but at a corporate profit level, not so much. If you think of Apple, Google, Microsoft, Marriott hotels, you name it, it doesn't seem that their profits would be deeply impacted by what's going on there. And the reason I say the signal is because if you look at January 1st to February 23rd, which is the day before the invasion, the market in the US was down maybe 11 to 12%, roughly, the S&P 500. So it was down even before the invasion began. After the invasion began, to the end of the quarter, which is like a couple of weeks ago, and at the end of March, the market actually, during that first month of war, went up about 7%. And again, it's not that the market's nuts. It's just basically saying that the corporate profits are not impacted as much because the market is forward-looking, trying to form expectations about profits years and years down the road. And again, this doesn't seem to be as big of a game changer for corporate profits. So remember that the economy and the stock market, even though the media kind of tosses them together, they're related because they have to do with business, but they're not the same because the economy is about the immediate impact. The stock market is forward looking about what's coming down the road 1, 3, 5, 10, 20, 50 years down the road. Many companies that we know and love, they've been around for 100 years or so. So certainly a very long-term proposition for the stock market. And that's one of the reasons that we haven't seen that. Now, we have seen more volatility in the market, and that's in a way, we looked at this and we asked, when you have a major event like this, is it unusual to see that the markets get choppier? And in reality, we see that that's a pattern that's happened in the past. It's a little bit, if you take a rock and you toss it into a pond, at the point where it lands, there are bigger waves. The ripples are relatively big. And it's kind of the same what we see with these events. At the time of the event, there's a lot of market movement, kind of trying to assess what does it mean for the corporate profits? What does it mean for these companies to have this event? And at the time, not having enough information and really trying to pile through all the uncertainty, you see market movements being quite big. But the same with the rock. At the point of impact, the ripples might be big, but as you give this time, these ripples tend to smooth out, and eventually they become smaller and smaller to the point where they become insignificant. And that's the same pattern that we see in the market. Initially, you have these big market movements, but once the markets gets a hold of more reliable information, starts incorporating them into prices, that volatility tends to subside. And we saw this in, Pearl Harbor. When Pearl Harbor happened, the day after, the market was down 3 to 4%. But then by the end of December 41, it was already up. You had 9/11. The market dropped about 7% when it reopened, and then eventually start kind of smoothing out. So, if you see the volatility, the market movement, that's not a sign there's something wrong with the markets. It's quite the opposite. It's the markets are doing their job, trying to incorporate this new information and figure out, well, what's the value of a company? How much did it change because of this? And then, last comment that I'll make, Gigi, on this. I was asked actually just over the weekend by some friends. Well, that's great, but what if we actually end up going into just something like either a nuclear war or some sort of a longer running Cold War like we used to have? And my first reaction is that if we do end up having some sort of a nuclear war, which there's always a chance of this, and that's priced in the market. I'm not sure that our investment portfolio might be the first concern. I think that at that point, I think we all have a lot bigger problems. And if there was to be a functioning market, if there's a company that actually makes money by helping people navigate this, well, that would be part of the stock market, and a diversified portfolio would have that company, and a lot of money would be redirected that way, and you would somehow tend to participate. But in other words, if there was a nuclear war, I think we'd all have bigger problems. What if we go into the situation of a more, long-running Cold War? And I just looked it up because I wasn't exactly sure how the market did during the Cold War. And I looked at the S&P 500, which is a broad measure of the largest 500 companies in the U.S. economy. And if you look at it over this period of the Cold War, and nobody really kind of pinpoint precisely when it started, but most historians agree that in March of 48 was sort of the beginning of the Cold War. But then we know it ended when the Soviet Union collapsed in December of 91. On average, annualized per year during these years of Cold War, what you saw is that the S&P 500 on average went up about 12.7%. So a really nice return. The long-term average is about 10%. So even as we had a different set of priorities as a country, there was a lot going on, the stock market actually chugged along. These companies found a way to make it work even in those Cold War days. But you can say, well, those are the bad days. Now we won. It's post-Cold War. We're all kind of holding hands and singing Kumbaya. The world is global in nature. How did the market do then? And when we looked at that in the post-Cold War era, beginning in 92 to the end of last year, what you saw is that on average per year, the market went up 10.6%, which tends to be the long-term average. In other words, I'm not suggesting that we should all root for a Cold War because the market might do better. What I'm saying is that there is no evidence that even if we were to be engaged into a situation like that, with a Cuban Missile Crisis, with all the money and the time and effort devoted towards defense, there is no signal that necessarily as an investor you would have been worse off than in any other period. So to me, ultimately, again, it comes down to this: it's emotional to watch what's going on in Ukraine. It has an immediate economic impact on us, but from a stock market perspective, there's nothing there to really say let's make a move, because this is one of those things that really should not be the trigger unless it's a rebalance situation, and that's what advisors do. If the market drops enough, maybe there's a time to rebalance and buy back in the market to realign the portfolio in the correct ways.
Thank you. Thanks, Apollo, for that explanation. It seems that the market has its own agenda, regardless of what's going on in the world. And I think that's always been the message, that, you stay the course, whatever your risk tolerances has been. Um,
Yeah, absolutely. And don't let emotions get in the way, because quite often we see this over and over. The emotions can trigger investors to act, but those actions are not always in the best interest of an investor.
yeah, yes, thank you. Well, I mean, another hot topic, moving on as far as, happening recently is inflation. It's dominating the news. And like you said earlier, we're all feeling the pinch at the pump in the grocery store. And now it seems to be spilling over into services. Can you give us some perspectives on inflation as well as a sense to what to expect looking ahead? And then also from an investor's perspective, what can we do to hedge against this inflation and stay ahead of it over the long run?
Yeah, no, it's inflation, and we can all see it. I mean, I don't know how it is, in Maryland, but right now in Los Angeles, it's about $7 a gallon. It's crazy. I mean, the prices are going up. Everybody's feeling this pressure at the grocery store everywhere we go. And let me start by just kind of demystifying that inflation, this idea of pricing going up from year to year, is not really something new. It's been in the U.S. economy for a long time. In fact, if you look over the long run, the average inflation rate per year, the average price increase per year from year to year, for the past 100 years or so, has been about 3% per year. And so inflation by itself, it's been with us. Now, the numbers that we're hearing right now are not 3%, but they're rather a lot higher. They're in the neighborhood of 7-8%. So it is higher than we've seen in the past, and doesn't mean it's going to stay high going forward. I'm going to give you a couple of perspectives. The first one is that right now there are two different scenarios that economists and investors are really putting out there in terms of what inflation could be over the next, let's say, 5 or 10 years. And in the first one, what they're seeing is that this is a transitional phase. And in this transitional phase from the pandemic type of economy to the post-pandemic, when we go back to normal, and also with the war the way it is right now, which is considered to be a temporary situation, not a permanent war, what you're seeing is in this particular time, because of this perfect storm, you're going to have some higher inflation. But eventually, once you get past the war and we go back to the pre-pandemic world, the inflation is going to subside, and this transitional would kind of give way to a more subdued inflation as we've seen in the past. The second narrative, it's a little more ominous, is basically saying, no, there's a human behavior in here. And from a human behavior perspective, what you see is that consumers are getting used to paying more, companies are getting used to passing those price increases, and workers are demanding higher wages. And when they demand higher wages, prices go up, and it leads to something called a price wage spiral that keeps the inflation higher for longer. And eventually, to combat inflation, you might have to induce some sort of a recession to cool off the economy. And right now, both of these scenarios are plausible. In fact, I can spend half hour arguing for each. The truth is that I don't know which one will come through. And in fact, I just, nobody knows. The president of the country or the Fed chairman, nobody really knows. But it doesn't mean it's hopeless. In fact, I'm going to suggest there's one a mechanism that is so powerful that to give us a sense of what to expect. And it's not because it's a forecast or it's an opinion, but rather it's almost, Gigi's like a referendum, where every day, investors vote with billions and billions and billions of dollars in the market onto what they expect inflation to be. And that referendum is in the way that they buy different types of bonds, some that are covered for inflation and some that are not covered for inflation. And the difference is known as something called the break-even inflation rate, which it's very well known among investors, not really well known among individuals. But I want to kind of suggest to you that this is a really important place to see, because in this referendum, you have both of these scenarios that get put in there. And ultimately, the number that emerges is one that combines all these different views, all these different expectations. So not one, but multiple views, multiple expectations. And the way that they're priced in is, again, using dollars rather than opinions and posts on social platforms. And that is something that is actually being tracked by the Federal Reserve. And I'm going to share with you the live website of the Federal Reserve that publishes, let's say, the 5-year break-even inflation rate. And since that's not a household definition, let's just go down and read exactly what it is. This value implies what market participants, all of them, with different opinions, what market participants expect inflation to be in the next 5 years on average. And that's why I think it's such a powerful metric, is because it combines all these different expectations and views of the world. And if you go back a few years, what you see is that inflation was unusually low. The Fed is a target of about 2%. For many of the past 5 years, we're way below that. And then when the pandemic hit, we had the opposite concern 2 years ago that, boy, prices are not going to go up. That's called deflation. And that's a bad thing by itself. And as the economy reopened, stimulus kicked in. Where we are tonight, as of last night, Monday night, the expectation for inflation over the next 5 years is 2.36%. That's where we are today, 3.36%, which is a little bit above the rate that we've had in the past few years. So certainly, it's higher. Yet on the other hand, it doesn't scream panic. To me at least, Gigi, doesn't seem like, wow, this is crazy high and we should all be in panic. So it doesn't signal that we expect over the next 5 years to have the same price increases that we've had so far. And in fact, this referendum takes place on a daily basis. And if you look on a daily basis, let's look at the 1 year track, and you go to the day before the invasion of Ukraine, the expected inflation was pretty much spot on the long-term average. When the inflation began, that's when you saw the expectation going up a little bit higher, but then since then it dropped back down. So this is not something that is static. You should look at this number and say that's what's no. Every day there's new information about wages, about price of fertilizer, about price of oil, about shipping, about supply chain issues, and all of these get put into this number, and that's why I think it's so powerful. So that's kind of how I think about inflation right now. Is not it's crazy, but also, if I want to take a minute, and I don't look at inflation as being a horrible thing, because it pinches us. We cannot buy as much. And in that respect, certainly that's not pleasant. Yet inflation reflects a reality of an imbalance between, not imbalance, but reflects the dynamics of supply and demand. And if we didn't have this price increase, let's say you folks who are, let's say, using fertilizer, if the price of fertilizer would not go up, but the production somehow would be hampered, like for the war, well, at the lower price, people would be inclined to buy a lot more fertilizer, and soon enough, you're going to find shortages. You're not going to be able to find it, even at a high price. So the price increase is reflecting the fact that there's a change in the dynamic of supply and demand. And as much as it's unpleasant to us, this dynamic is just something that it's almost necessary, because otherwise, if there's not enough fertilizer and the prices are low, people are going to buy them like crazy. But the prices being higher, you're a little bit more judicious in the way you buy it. And the only trouble that I've seen in the past when I examined this is there are two situations when we saw really big inflation spirals in the US. And what's fascinating is that in both of these cases, it was because the supply and demand, the market forces were not allowed to operate. And the first one was, and Gigi, you're too young to, I was too young, but I wasn't even born. But the first time we saw this is during World War II, when we moved from an economy that was supposed to be a civilian economy to one that produces goods for the military. And at that point, in order to supposedly protect the civilian population, the US government put in place something called the Office of Price Administration, or the OPA. And I started digging into it, and I thought it was quite fascinating because the OPA basically created this big book with everything from a cup of soup to a can of tomatoes to anything out there had a certain price attached to it in terms of points, and you couldn't change it. And in fact, what was interesting is that price control was supposed to make it better for people, and there were enforcers in communities who were basically reporting restaurants or places that were kind of going above that, and that's what the government tried to do, is try to instead of letting the supply and demand do its thing, and just say, well, why don't we suppress the prices, and then that's gonna help everybody. But the trouble was that when the OPA was eliminated in 1946, we had the highest inflation year on record in 1946, plus 18% inflation in 1946, because we had all these years in which the supply and demand were not allowed to operate. And so, whenever you introduce these mechanisms that don't allow supply and demand, you could actually lead to higher inflation when these mechanisms are released. And the second one is in 1971, when we moved away from the gold standard. So at that point, we had a gold standard, and the dollar and the gold were tied. But in 1971, that was changed, and we basically cut that link between the gold and the dollar. And it was supposed to be a 90-day wage and price freeze. You couldn't raise prices, you couldn't pay workers more. The trouble is that that was in August of 71. That mandatory price control was not lifted until 1973, about a year and a half later. So by then in 1973, you had a year and a half of compressed prices, and when those controls were lifted, once again we saw a huge spike in inflation in 1973. And then on top of that, as you know, it wasn't just that, but we also had the oil crisis, and the oil crisis was a really big deal because we didn't have enough oil for the economy. So in other words, what I'm saying, when you look at these price increase and inflation going up, I'm actually very confident in the mechanism of supply and demand to alleviate some of these issues. It's that when the government tries to control it, that's when it becomes a bigger issue. Now, from an investor, because you also asked, as an investor, what do I do? Well, there are two things that you can do. One, if you're concerned about inflation on a daily basis and you really don't want you don't want to deal with it, there's something called hedging. And what hedging allows you to do is every day be protected against inflation. And probably the best way to do it is not to buy gold or something like that. The best way to do it is to look at some government bonds. And a bond is a form of lending. The government needs to borrow money. You can lend your money to the government. And one of these bonds is a very specific type of bond that basically says that it starts with a certain level of inflation and a certain value of the bond. But as the inflation goes up, the value of this bond moves in lockstep. And those are called Treasury inflation protected securities, or TIPS. And what's great about those is that as inflation goes up to whatever level, the value of the bonds move in lockstep. So if you really want to be protected, those are an interesting option. And in a certain Gigi and the advisors are familiar with those. So that's something that you can do. There are also some funds that have regular bonds, and on top of them, it's called an inflation swap. It's almost like, if you think of an insurance, that if inflation kicks in, then it goes up, then these kick in and actually give you a kicker there. And those are also called real funds that are available to you. So those are things that you can do on a daily basis to hedge. But if if there are investors who would rather kind of think, no, I want to retire in 10 years. Let's just say that's me. In 15 years, I want to retire. And I want to make sure that I stay ahead of inflation with my investments over the next 15 years. Well, which one of these investments actually stay ahead of inflation over the long run? And particularly, let's say that we have above, like a little bit higher inflation. So we took all the inflation years from the lowest to the highest, and we cut it in half. and we discarded the lower half of inflation years, and we only looked at above median inflation years, so the top half of inflation years. And we asked the question, how do different investments perform in that environment? So what we found is that the government bonds issued for a very short term, 30 days, called the Treasury bills, when you account for inflation, which is called a real return, in these above median inflation years, you actually are not ahead of inflation. What it shows is that on average, over these above median inflation years, in Treasury bills, you are below inflation by 0.6%. But the government also issues some longer term bonds, and those are up about 0.4%. So you are getting inflation back plus 0.4%. So if you look at bonds, you got to be careful which ones you buy. And there are also some corporate bonds. And what those corporate bonds give you is inflation plus 0.9% on top of it. So certainly a good, a better option if you look into to outpace inflation. The stock market, really good news. The stock market, even in these above median inflation years, on average, you got inflation back plus on top of inflation, you got 4.9%. And in the market, in the stock market, you do have some large companies that are well established. They're called large growth typically, and they have stayed ahead as well. And some of the tech stocks are part of this category. But you also have, instead of large, small, and instead of growth value, is a diversifier. And these small value have also stayed significantly ahead of inflation. So the good news is that even as we have inflation, Gigi, you have arrows in the quiver. If you want to hedge it, boom, you got some tools there. You got the tips. You have these real return funds. If you want to outpace it over the long run, if you want to stay ahead of inflation, certainly building a diversified a portfolio that's balanced between stocks and bonds, it seems to be really good evidence that over the long run, it will stay ahead of inflation.
Apollo, and I agree with those terms, everything you've said, but I do get some questions on other what are considered inflation hedges, if you will. And I was wondering if you could weigh in on gold and Bitcoin. And I know you touched a little bit on gold, but if you could talk a little more about gold and inflation hedge properties and Bitcoin as well.
Yep. So when it comes to gold was a fantastic hedge against inflation up until 1971. Because up until that point, for every dollar that was printed, there had to be a certain amount of gold. That was called the gold standard. So in that respect, you can always go to the bank and you'd get the gold and vice versa. And in that respect, gold was a great hedge against inflation. Without in my mind, it was a great hedge when we had the gold standard. As we moved away from the gold standard, what it meant is that in order to print a dollar bill, the government does not need to have gold in the bank. The government can just print money at will. It's called fiat money. It has value because we believe it has value. And at that point, gold has nothing to do with the dollar anymore. And it's a legacy idea when in fact, if you look at the data, you don't see that gold is really a good hedge against inflation. And for two reasons, I'll give you two examples why I don't think that's the case. If you look at 1980 or so, for 25 years, to 2005 or so, over that course of time, the price of gold was basically unchanged. 25 years, the price of gold did not change. Yet, whatever you needed a dollar to buy in 1980, by 2005, 25 years later, you wouldn't have needed $2.50. In other words, the prices have increased in the economy about 2.5 times over the course of 25 years, yet gold had not changed at all. So where's the hedge? Everything is 2.5 times more expensive. Gold is exactly the same. So in that respect, again, there is no real data to say that, gold is so good. There is no economic theory to believe that. But lastly, which I think is probably the most interesting to me, is that people are looking at gold as a hedge against inflation. And yet, if you look at the prices at the grocery store, at the pump, whatever you look at, whatever the furniture, the prices, even as they grow over time, even in this high inflation of about 7% or so, the fluctuation in prices is relatively minimal. You don't see the prices fluctuating that much at the grocery store. They go up a little bit, but it's a relatively small fluctuation. Yet what's so fascinating is that if you look at the price of gold from day to day or from month to month, it fluctuates something like this. So it's really hard to make an argument that listen, I'm going to take something that fluctuates something like this, which is gold, and I'm going to try to hedge something that moves like this, which are the prices. It doesn't make a lot of sense to me. How can you hedge something that has so much volatility? How can you hedge something that has so little volatility with something that moves in price so much as gold does? So there's no real data, and again, it's a legacy thought that somehow gold is good for hedging against inflation. That used to be the case. It's no longer, because it really does nothing to do with the dollar anymore. What about cryptocurrency, Bitcoin? Some folks have been looking at that. And there are two thoughts. The first one is crypto is really new. I mean, crypto came along in 2009. We only have 13 years of data. And in these 12, 13 years, inflation has been incredibly low. So you can't really really look and say, I have good data to show. But what I can tell you, folks, is that inflation started to spike about November last year. So we had about 6 months. So the question is, as inflation started to go up, starting in November, what did Bitcoin do at the same time? And what's fascinating is, as inflation was going up and up and up, Bitcoin crashed and lost a third of its value. So I'm not sure, again, where the idea of the hedge against inflation is. If people are saying, well, it's a limited amount of 21 million currencies, units of Bitcoin, and that's a limited supply, and that's going to keep its value, I'm not sure that's a positive, in fact, because it's exactly what gold's problem was in 1971. The economy was growing. You had more productivity, more economic activity, more people in the world, and you're constrained by how much gold we had. And at that point, you kind of say, well, we can't keep this up. We need more dollars just because there was more economic activity and more people. And it's kind of the same with Bitcoin. I'm not sure that's actually a good thing to have a limit, because that was the Achilles heel to gold, and it doesn't make any sense. If you look 20 years down the road, we're going to have more people in the world. If you have a fixed supply of a Bitcoin, it doesn't work that way. You need to grow the money supply, and that's the problem that the gold had. And I think that Bitcoin is headed in the right direction, the same direction. So again, I don't know. I don't believe that either of these are good hedges against inflation.
Thank you. To dig a little deeper into bonds and how they are reacting to interest rates, could you touch on talk a little bit about the history of interest rates? So they were at historic lows. They've been going up and up and up a little bit. The Fed's starting to increase the rates last quarter. What will that impact be on bonds, stocks, and the overall economy as the Fed forward? I guess we're expecting a few more rate increases.
Right. Certainly a lot. I mean, you hear about over the next year or so, there will be significant increases trying to control inflation. And what happens is, in economic theory, as interest rates go up, companies are borrowing less because it's more expensive. So the economic activity slows down. Consumers are supposedly, buying less. Mortgages are going up. Mortgage rates have gone up about 1.5% to 2% over the past year or so. So the idea, the economic idea is that interest rates are going to slow down the economy. And as the economy slows down, people are not buying as many things. It kind of reduces that pressure on prices. Because if the companies are making things, but people are not buying them, eventually you can't charge more and more. Eventually the prices are going to start stabilizing. That's the economic theory. And that's what the Fed is really trying to do. And the thing that's interesting is that the news out there that the Fed is raising rates, it's a little bit inaccurate, because the word rates is inaccurate. The Fed is not raising rates. The Fed is raising one single interest rate. And this is a bit of, it's a really interesting idea that the Federal Reserve, which is the central bank of our country, it doesn't control every single rate in the economy. In fact, it only controls one, which is a very short-term lending called the federal funds rate. But this federal funds rate is one of the many, several hundred different interest rates that exist in the economy. Your mortgage rates are not controlled by the Fed. Not at all. Not at all. The government, what government borrows is not controlled by the Fed. There are hundreds of different interest rates. What Macy's or Apple pays on their bonds is not controlled by the Fed. They have their own supply and demand dynamics in the market. And to illustrate this, I just to kind of show you visually, the federal funds rate changes. So the Fed can change that rate of the federal fund rate. And if you look over the past 20 years or so, since 2000, what you see is that some years the federal fund rate went up about 1%. In other years, it dropped about 4.5% or so. In many years, it was left unchanged. Last year was completely unchanged. That's why there's nothing here. But what's fascinating, Gigi, is that if you now look at a different interest rate, let's say the government bond for 10 years, which quite often is tied into the mortgage rate. The question is, does it move in lockstep? As the Fed changes these rates, is the 10-year treasury, the 10-year government bond, is it moving in lockstep? Is that interest rate also moving in lockstep? So what's fascinating is that if you overlay and you look at the yellow dot as being the 10-year treasury yield, which is the interest rate on the treasury, what's fascinating is to see that they're not really moving in lockstep at all. In 2000, the Fed fund rate went up. This 10-year rate went down. Here in 01, this Fed fund rate went down significantly, and the 10-year didn't change. You had years and years here when the Fed fund rate did not change at all, and yet we had these big movements in the 10-year yield. And the same last year. No movement in Fed fund rate, but certainly we saw a big change in the 10-year yield. So when you look and say the Fed is changing rates, no, folks, it's only changing one rate. The other ones have their own dynamics, their own supply and demand, and they're not tied in as much as people think into the Fed fund rate. So don't go out thinking like, oh, all the interest rates are going to go up. That's not what the evidence shows. Is there could be that the interest rates might actually go down. They could go up, but they could also go down. It's not clear to me that they have to move always in lockstep in the same direction. They could, but they don't have to. So that's the first note that I would have on this. The second is, now let's look at see what happens when we do have periods of the Fed raising rates, because that's what the concern is. The Fed's going to raise rates, and they cannot be good. The stock market rally has been fueled by these low rates. As the rates go up, the companies are going to run out of steam, and you're going to see a slaughter in the market or in the economy. So as an investor, what's the data saying? Again, let's look at the past 20 years or so. And what you see is that there were two periods when visually, it's very obvious that we had a period of rising rates. We had the first one here, which was between 2004 and 2006, where for 3 years, the Fed kept raising rates. They went from being very low to quite about a 5%. So it's about a 4.5% increase that we saw in that time. And then also 2016 to 2018, once again, 3 years of rising rates. We were very, very low rates, and then we had 3 years of rising rates. So, there are some periods that at least we can look for and see what did the stock market and what the bonds do in these periods of higher interest rate increase and more interest rate increases by the Fed. So let's start with the first one. If you look now at the first period, 04 to 06, in 2004, the S&P 500, the measure of the U.S. market, was up about 11%, 10.9%. 2005, about 5%, 4.9 to be precise. And in 06, 15.8%. So what's so interesting, Gigi, is that we had 3 years of rising rates that were supposed to be devastating for the stock market. Yet in every single year, the market went up. And to me, it kind of reflects something that is fundamental. The value of these companies, the value of the stock market in general is really dependent on many variables, tons of variables. One of them being the Fed and the interest rates. But it doesn't appear to be a primary variable. It doesn't, particularly seem that the profits of Apple or Google or Microsoft or Coca-Cola are tied into that rate. It seems like there are other dynamics in the market, other variables that could drive the market higher, even when the interest rates go up by the Fed. And in fact, if you look at the other period in 2016 to 18, once again, you see that the market was up in 16, the market was up in 18, and 17. Almost 22%. But in 2018, we did have a down year. So it's not that in every year when the rates go up, the market's going to do well. It could be that it goes down. But to me, what it shows is that it's evidence to me that there are many variables, and this doesn't tend to be a primary one, but also it doesn't appear to really be a disaster for the market, that you can go and say rates are going up, stock market's going to go down. I know that that's not the case. The data doesn't show that. So I'd be cautious. There are many other things that might drive the performance of the stock market this year, not necessarily related to the rates. So don't go out there thinking that, oh, the Fed's going to raise rates, I need to do something with my money. There's so many other variables that drive the market. And even in rising rate in years, the market has done actually really well. 5 out of the 6 years of these rising rates, it went up. Now, what about bonds? Because that's another concern. When you look at bonds, you do have this really long period here when we had very low interest rates followed by an increasing rate. So at that point, folks might say, well, it doesn't make sense to hold the bonds. One of the primary functions of bonds is to provide some counterbalance to large potential market downturns. But even in these years when we had very low and rising rates, what's fascinating to see is that the bonds actually did very well. On average per year during these 10 years of very low and rising rate, on average, if you look at just a very diversified, broadly diversified set of bonds in the US called the Bloomberg US Aggregate Bond Index, on an average basis, you would have made about 3.48% per year during these 10 years. So certainly not a devastation as one might have thought, but rather it's just like, we had very low rates. Once again, the dynamics of the bond market being driven by more than the Fed, and even in this very low or rising rate environment by the Fed, it doesn't mean that's going to be a disaster for the bond market. And because of the reason, we're not really recommending that the Fed decision should form the basis of making changes to the stock or the bond portion of the portfolio, unless it has to do with rebalancing or perhaps loss harvesting if it's appropriate.
Thank you. That totally makes sense. Sometimes I guess we get a little bit of tunnel vision and concentrate on what's what the headlines are in the news as far as the Fed rate and the Ukraine crisis and things like that drive our emotional investing when we really should stand back and let the market do its thing.
It's almost like you look at an athlete. You look like Michael Phelps, and says, that guy swims like that and looks like that because he eats yogurt in the morning. I mean, that's one of the many things that he does to get to where he is. But you cannot ignore everything else. But it's easy enough to simplify the world and say, aha, it's the yogurt that makes him look so fit and all that. No, it's many things that kind of contribute to that. That might be one of them, but I wouldn't pinpoint it and try to explain it. But the media, as you said, it has a tendency to oversimplify, and try to make this direct correlation so we get a sense of control. Aha, I understand why the market's doing that. It's a little more complicated than that.
Yeah. And I think we're always surprised by that. I mean, look at 2020 during the pandemic, whenever, the market, had that big crash, and then what happened, by the end of the year, we were up. So, it will continuously surprise us.
Oh, and it's not just 2020, Gigi. If you look at 1980, I mean, that was a shock to me. If you look at 1980, we had a terrible year. The Fed raised rates in 1980 by about 4.5%. We had, beyond just the Fed going up by 4.5%, roughly speaking, the federal funds rate, you had very high unemployment. You had, low industrial production, very high inflation, very low housing starts. So at that point, you say, well, it's a perfect storm for the market to do terrible. And yet in 1980, the stock market, the S&P 500 was up about 32%. That it's not always that what's going on at the moment, because remember, folks, the stock market is forward looking, is really trying to figure out what's going to happen next year, the year after, the year after. And so it doesn't get bogged down on the immediacy of how things look.
Appreciate that. Is there, can I throw one question out to you?
Absolutely.
So with that said, markets aside, we talked about the difference between the market and the economy. Many questions I'm sure we're going to be getting as this, the Fed talk keeps, being the top headline. What about recession and how that fares for the market?
Yeah. And that's because quite often we do see that recessions are top of mind for investors, and 1980, as I said, was a recessionary year, and you kind of see that it has an impact on the economy. What we tend to see is that the markets, by being forward looking, they actually, what they do is they price in the recession before it actually happens. So, if market has an expectation there's a recession coming down, it will price that in before it even happens, because that's the beauty of markets, are forward looking. So when we are in the middle of the recession, by then, those factors that are in the recession, they've already been priced in. And what the market does at that point is goes and looks beyond the recession. Okay, once we get out of this, what do we see going forward? And 1980 is one example. The other good example is if you look at 2009. In 2009 was the worst economic downturn probably since the Great Depression. We had a horrible situation in the country, very high unemployment, very low economic output, a lot of foreclosures, a lot of pain. And again, this was the worst year of the economic downturn of the great financial crisis. And what is surprising to folks is that the market in 2009 was up a whopping 26%, more than twice the long-term average, even though we're in the middle of this recession. So recessions, they're certainly not good for the market. The thing is that the market tends to price them in before they happen, because the market is forward looking. And when we're in the middle of the recession, quite often what the market does, it sees the light at the end of the tunnel. And that's when it prices it in and maybe sees that the value of these companies will go up. Now, from an investor perspective, what we see over and over is that a lot of folks, when they are in the middle of the recession and they see things don't look good, there's a tendency to sell. And that's probably the worst time to sell, because the nature of the markets to fluctuate. And if you sell thinking there is a recession and that's not going to be good, the trouble is that first of all, the market might surprise you and go up in a recession year. But secondly, if you try to take an action because of a recession, the trouble is knowing when to get back in, because if you sold at this level of the market and the markets are fluctuating, the thing is that it would be ideal for you to buy at this level or below, because that's when you save yourself money. When you buy back in the market, you buy at a lower level. But what we see is that most often, by the time the recession looks better, the prices have already moved up. So if you don't know when to get back in, you might have sold at this level, but when you buy back, is at a higher level. And in fact, you've costed yourself some potential returns. So not knowing when to get back in, I think, is the biggest issue with a recession. With any time of moving out of the market, it's like, yeah, you sell because you don't find that it's a good time to invest. The trouble is, when do you get back in? And that's why I think the biggest issue is for investors, knowing when to get back in the market. So for that reason, we don't think that a recession should form the basis of moving in out of the market. It might impact our wallets because, as I said, the economy is going through recession. So there's an immediate impact on us, but the market and the economy, they're not the same. They're not the same. And that's what you have to keep in mind, that even in the recession years, the market could do incredibly well. And the last point that I'll make, Gigi, we've been talking about the market is what we see on the news, which is the Dow Jones, the S&P, NASDAQ. Those are the three big metrics. But in reality, folks, your portfolios actually look quite different. In one regard, you have some bonds. And to the degree that you have some bonds and stocks don't generally move in lockstep. So you might have a decent proportion in bonds. So what you see on the news is not necessarily in line with the fact that part of your holdings are in lending. But secondly, we talked about it. There could be a global component to your portfolio where the S&P is only part of it. And if you compare now, what you see on the news with your much more globally diversified portfolio, there will be a difference. And quite often, we saw this in the past, is that the difference could be significant. And they will, don't be surprised if some years you're not doing it well as well. But don't be surprised that if the market's down in the US, you're going to be actually maybe ahead in this globally diversified portfolio. So it can go both ways.
Wow, thank you. I think you answered all of our questions that were in the front of our minds. And, like you said, driving that point home, not market timing, diversified portfolio.
Yeah.
Basically, just turn off the news is what you're saying. So
yeah, turn off or just try to disentangle the news from what I should be doing with money. But ultimately, you have folks, if you have a plan with Gigi and PKS, that plan was built to withstand both recessions and inflation and to give you the best chance to accomplish your financial goals. So all of these things that we talked about, actually, it's on the back burner. Really, the thing that matters the most is to have a plan. Once you have that plan would lead Gigi and the team to come up with an allocation that is appropriate for you. When do you need the money? How much money do you need? And at that point, again, depending on your risk capacity, depending on your timing and how much money you need, it's possible that your exposure to the market to begin with might be smaller than you think.
Right. Well, thank you again for answering these tough questions. I truly appreciate your insight, and you certainly live up to your name, the Secretary, explaining it all. So we're over our time limit here. So I'm going to let you go. And if anybody has any other questions, you can follow up with PKS and our advisory team anytime. Thank you, Apollo.
Thanks. Bye-bye.
Bye.